用我呢個先，係啦，用我呢個先。 Welcome to the Digital ID and Know Your Customer Utilities for Embracing the FinTech Era, co-organized by Hong Kong U-Space, Financial Service Development Council, and supported by CFA Institute and Hong Kong Society of Financial Analysts. I'm Ringo Chan from Hong Kong U-Space. Hong Kong government established Financial Service Development Council in 2013, which is a high-level advisory body to engage the industry in making proposals to promote the further development of Hong Kong financial service industry and to roadmap strategic direction for the development. As you can see, Financial Service Development Council set up 5 committees, including policy research, mainland opportunities, new business, market development, and human capital committees as the 5 streams of its work. Financial Service Development Council Practitioner Speaker Series is project developed between Financial Service Development Council and local universities. The website, they also offer lots of useful information for career developments in financial services. Let me introduce our speaker tonight. Professor Douglas Ernest is Financial Service Development Council member, Carroll Holdings Professor in Law, University of Hong Kong. Professor Ernest specialized in economics and financial law, regulation and development. He served as head of development of law of University of Hong Kong from 2011 to 2014, and director of Law's Faculty's Asian Institutes of International Financial Law from 2006 to 2011. He's also co-director of Duke University and University of Hong Kong Asian American Institute in Translational Law and Senior Visiting Fellow of Melbourne Law School, University of Melbourne. Mr. Jeremy Lam is Financial Service Development Council Policy Research Committee member, partner, and head of financial service practice at Deacon's. Mr. Lam specializes in financial services with a particular focus in retail investment funds. He's also advised on a wide range of securities, asset management, compliance, and regulatory issues relating to the asset management industry. Mr. Lam served as firm's executive partner from 2008 to 2012 and a member of the firm's management committee. May I now invite Mr. Kelvin Yeung, acting head of College of Business and Finance, Hong Kong U-Space, to give us opening remarks. Mr. Yeung, please.
Okay, Professor Anna, Mr. Lam, distinguished guests, good evening. I'm very pleased to be with you at the Financial Services Development Council Practitioner Speaker Series in Digital ID and KYC Utilities for Embracing the FinTech Era, co-organized by Hong Kong U-Space, Hong Kong Financial Services Development Council, CFA Institute, and Hong Kong Society of Financial Analysts this evening. I extend my sincere appreciation of the support from our partners again. So, I finished the formal part from my colleagues, okay, with all the mandatory information. So now, this is my part. I'm not a financial expert, so that I really know very little about the topic tonight. But when I asked Ringo about what these technologies can help us, he told me some very simple things. That with the digital ID and also with the KYC, Know Your Customers Utility technology, the banks and the financial institutions will save much time in identifying me as a customer, in saving much time, much efforts, so that I will have better experience. I will be able to enjoy a better service. I think this is what I would like to know. And these are the very important elements to keep Hong Kong as a pioneer, as a very professional image in being one of the major financial centers in the world. So this is what I would like to know, and this is why Hong Kong New Space is very honored to be one of the co-organizers of tonight's forum, tonight's sharing. So we will have two very distinguished speakers to share their thoughts, their opinions about the key elements of these technologies tonight. And being professional and being a pioneer is also the strategy of the College of Business and Finance in Hong Kong New Space, so that we are eager to offer these type of forums, sharing sections, and also programs of similar and relevant topics in this field too. So again, I would like to thank you all to attend this event tonight, and I'm sure that we will enjoy and learn a lot. Thank you very much.
Thank you, Kelvin. Now, may I invite Ms. Mary Learn, Head of Standards and Advocacy, Asian Pacific CFA Institute, to say a few words. Ms. Learn, please.
I'm afraid I have no formal part to my address, but I would like to thank everyone and extend a warm welcome to all of you who are here today on behalf of the CFA Institute. And we're very honored to be a partner to FSDC for tonight's event. As an independent professional body, the CFA Institute supports financial innovation, and the key to us is that when we apply technological solutions, that consumer protection, market integrity, and market fairness must be upheld. So digitalizing the client life cycle is the trend going forward. Now, taking eKYC as an example, an effective eKYC infrastructure will do wonders to not just our business, but also improve the transparency, accuracy, and the security of that data. So I was very excited to read FSDC's new paper because it's about building this new infrastructure so that we can all benefit. It will deliver KYC solutions to enhance the competitiveness of the industry as a whole and enhance Hong Kong's position as the international financial center. So we should all be very excited about the possibility that this is going to bring to all of us. However, there's still work to be done. We don't have answers to all the questions yet. I think as some of the recent events have showed us, there's still key questions to answer, such as security, data privacy, authentication, and identification. And I think our speakers tonight will have their work cut out for them, because they will have to achieve this very delicate balance between technological advance and protecting consumers. Now, FinTech is an ongoing topic for the industry and for the CFA Institute. So we're looking forward to producing more research and contributing to the topic. So watch this space. We're going to be back. And without further ado, let's start tonight's main event. Thank you.
Thank you, Mary. Now, may I invite Mr. Yuan to present our souvenirs to our speakers tonight. Kelvin, please. And may I invite Professor Anna? Thank you. And Mr. Lam, please. Okay. Kelvin, please stay. And may I invite again our guest speakers come here to have a group photo. Now, without further ado, may I invite Professor Ernest as our first speaker tonight to share his insight into the digital ID and KYC utilities. Professor, please.
Thanks very much, Ringo. Thanks, Kelvin, and thanks, Mary. I'd like to first thank SPACE, CFA Institute, and HKSFA for putting this together, as well as all of you for joining tonight. I would also like to thank Agnes and the team at FSDC for pulling it all together. This is part of our FSDC Practitioner series, but it's also an event for Hong Kong FinTech Week. And it's amazing that at this point on Thursday night, after a full week of FinTech events, that we can still manage to have a full crowd. So I'm very happy to see you all out this evening. Basically, what we're going to do is I'll spend a few minutes talking, then pass over to Jeremy, and then I'll talk some more after Jeremy, and then after that, both of us will come up for a bit of Q&A. This should make it a little more interesting than if one of us talks, the other talks, and then, so I think it should work well. Financial Services Development Council. We are a government advisory body that was set up almost 6 years ago. It is essentially a private sector body. I'm, in fact, the only academic on the Financial Services Development Council. And essentially, our remit is to advise the government on ways to strengthen the competitiveness of Hong Kong as one of the world's leading financial centers. And as part of that, we focus on a wide range of issues, often looking for specific pain points that people in the industry, in the markets, are experiencing. And I have to say that over the past 6 years, and it's something that most of you will know as well, across almost every discussion with every participant in the financial sector, one issue comes up more often than any other as a primary pain point in doing business. And this is from the formal financial institutions to startups to small businesses seeking to open accounts, and that is issues of AML and KYC. Money laundering requirements, know your customer requirements, and the challenges of customer onboarding and maintenance of related requirements. There are a large number of reasons why this is the case, and this is something that Jeremy and I are both going to look at throughout the presentation this evening. But I think as a result of this, and it came up particularly in the context of some of our FinTech work, but also in issues around asset management, particularly non-face-to-face onboarding of clients, small businesses opening accounts. It's something that has been widely reported in the press. In the context of people of any sort opening accounts in Hong Kong, this is likewise something that has widely been experienced. And as a result, we decided about a year and a half ago to undertake a study to look at this issue. And we put together, as we always do, a working group made up of a range of industry practitioners, lawyers, bankers, insurance specialists, accountants, startups, a range of people from different backgrounds to begin digging into the issue to try to identify what sort of problems people were experiencing, and then to look at how solutions might be built, and to build a report, as we've done, and there are copies available here as well as on our website, which detail the various conclusions that we found. And I think when we think of digital ID, KYC utilities, and the account opening problem, the starting point is that over the past several decades, everywhere in the world, a series of requirements around know your client due diligence, customer due diligence, around money laundering, countering the financing of terrorism, around sanctions issues, and around others have arisen. These have been developed primarily by an international organization called the FATF, sometimes called the FATF, sometimes called, it's by its full name, the Financial Action Task Force on Money Laundering. FATF is an organization. Hong Kong is a member. China is a member. Most of the world's major financial centers, all of the world's financial centers, are members. The FATF comes out with international standards which then have to be implemented into the legal systems of individual states, regardless of whether those are members or not. And if the FATF, in its periodic reviews, judges that a jurisdiction, whether or not it's a member of the FATF, is not meeting those standards, it will put that jurisdiction on a watch list, or in many cases on a blacklist. The end result, as many of you will know, is that then regulators in individual jurisdictions, the Federal Reserve, the OCC, the HKMA, the Bank of England, and many others around the world, will then issue notices which say that business with clients from North Korea or Iran is prohibited due to issues around violations of their regime in the context of money laundering. And so it's something that affects every aspect of financial services. And of course, if we think of Hong Kong, two of the most high-profile incidents, the impact of it in terms of real businesses have been seen. HSBC and Standard Chartered have both paid quite literally billions of US dollars in fines for violations of AML, CFT, and sanctions in multiple countries. It's something that is a major ongoing concern for financial institutions everywhere. And so, in the context of this paper, we particularly sought to address issues around opening of accounts for individuals, for corporates, and in particular around the challenge of non-face-to-face account opening, both from the standpoint of barriers in the existing complicated regulatory regime, as well as from the standpoint of technology. And it's something that many of us will often say, that Hong Kong is a place where it is more difficult to open accounts. Is there any proof of that? Well, in fact, Thomson Reuters does every year a survey of major financial institutions and how long it takes to open a corporate account in one of those jurisdictions. And amongst our competitors, major financial centers like Singapore, New York, London, Switzerland, Hong Kong is the jurisdiction where it takes, on average, the longest amount of time to actually open a corporate account. So it's not just a perception, it is a reality that in fact, for a variety of reasons, it is more difficult to open accounts here. And this is something that has been highlighted repeatedly as a challenging cost to business in particular, but also a competitiveness problem. And I'd like to pass the floor to Jeremy right now to talk about some of the reasons why this is and some of the things we might be able to do about it. Jeremy.
Thanks very much, Doug. And don't worry, Doug will be back. I must say I was quite enjoying his eloquent lecture, but sorry, you've got to put up with me for about 15 or so minutes. I think this slide, just by way of a sort of a brief picture illustration, says a lot in terms of the balance that we're trying to deal with. And you've got the you've got the sort of regulatory and governmental issues in terms of wanting to protect market integrity, trust in the financial system, reduce criminal activity, and also facilitate access to financial services. And on the other side of the scale, you've got industry and you've got end users who basically want to access financial services. Industry wants to be competitive. Hong Kong wants to be competitive. And as was mentioned in the beginning, customers want a good experience. So there's a lot of things to be balanced. And I've perhaps I was too diplomatic. I put the scales as being equally balanced. I'm not entirely sure whether that's right, but let's see. As was mentioned in the beginning, it's FinTech Week, and there was an opening address by Ashley Alder, who's the current Chief Executive Officer of our Securities and Futures Regulation. So there's just a couple of quotes I just want to take from there, because I think it gives quite a good indication as to what the regulatory tone is around FinTech and some of this. And what Ashley said earlier this week is, there is clearly an excellent case for adapting our rules so that technology can be used to provide a better customer experience, to increase financial inclusion, or to make markets far more efficient and reliable. So we have worked hard to make sure that regulation keeps up with new business models. He also went on to say, our rules are meant to be principles-based and technologically neutral. The challenge is how to apply consistent principles of investor protection and provide useful, detailed guidance on the use of innovative technology in this new, fast-moving environment. We and other securities regulators around the globe want FinTech to flourish in a way that promotes a high level of confidence for all those who participate. And I've got absolutely no idea that that's a very correct and fair representation of what the SFC and other regulators ultimately are trying to do. But it remains a significant challenge simply because the pace of change is always going to outstrip the pace of regulation. And this is one area where the regulators they want to regulate before you can do something. And sometimes things are allowed to develop and then it's regulated. I think in this sort of area, because it's so crucial and fundamental to the integrity of the market, regulators are very keen to ensure how it's regulated before it's allowed to take off too much. Now, as Doug mentioned, it is very complicated, and the reason for that is just a plethora of legislation and regulations, guidelines around this area. So I just, on the next few slides, just want to give you a flavor of what I mean by that. And the overarching, the main ordinance is the Anti-Money Laundering and Counter-Terrorism Financing Ordinance, and that's the main one that I'm going to be focusing on, because in terms of KYC, customer ID, it's dealt with that. But this whole issue of AML, countering terrorism and customer due diligence, it runs throughout all these primary pieces of legislation. And then in addition to legislation, you have guidelines, circulars, and FAQs. And unfortunately, not just one set of comprehensive guidelines and circulars. These are issued by each different regulator. And so one of the challenges has been for industry is trying to piece these regulations together, trying to ensure and remain compliant with some regulations which are not always consistent. The HKMA, today, normally what happens when you're about to give a talk, something happens. So today they issued their new guidelines on anti-money laundering, as did the SFC. The good thing is we've had an opportunity to read it because there's been quite a long consultation period, and in advance, I think they must have been advised that we were talking this evening, so they issued the consultation paper in advance, setting out the new revised regulations. And so one of the things that we asked for in the paper, we said we want greater harmonization of some of these regulations, and I think what has come out of this consultation and the new guidelines goes some way to achieving that. There is still issues to be addressed, but I think at least that's a positive I would start on. So you'll see that from the HKMA's perspective, their primary guideline is the one right at the top. They also have a policy module in terms of how to implement things. They also have frequently asked questions. Now, this sounds like a good idea, and it is a good idea because it allows industry, it allows practitioners to write in with specific questions, very specific questions, and you get the regulator writing back with a very specific answer to that, and that's helpful. But as you can see, that some of these questions are asked back in 2012, so you have FAQs dating back 2012, which remain relevant, yet they remain in publication. So in terms of how to sort of bring this all together and consolidate it, I think we're not there yet. The SFC, again, as I mentioned, they also issued their revised guidelines on AML, and again, effective from today. They also have a code of conduct for persons that are licensed with them. They also have issued various circulars throughout the years, and also they've issued, again, a sort of a Q&A, some of which, again, in terms of relevance, date back to 2012, as well as the most recent one, 2018. So again, if you're dealing with the SFC, you've got to look back. You've got to be able to pick the relevant information from the ordinance, from guidelines, from Q&As, and from policies. The insurance authorities, being the third regulator, again, has issued their, it's all been coordinated, so their guidelines have come out also effective today, and there's a lot, and there is a lot of consistency through them, but they've also got circulars and FAQs. Why is it important, and this client identity issue? It's important because the legislation and regulations require specifically that prior to establishing a business relationship with a customer, a financial institution is required to identify the customer and verify the customer's identity using documents, data, or information by a reliable and independent source. And this obligation arises irrespective of the type of financial industry that you're in. When we talk about ID to be collected, what are we talking about? We're dealing with individuals, we're dealing with corporates, we're dealing with partnerships, different legal structures. Some of these are going to be in Hong Kong. A significant amount are going to be outside of Hong Kong. And so this whole issue of non-face-to-face and dealing with it, sometimes it could be a challenge in Hong Kong, but the biggest challenge really is how to onboard overseas clients, whether it's an individual, an overseas company or partnership, into the regulatory environment where a lot of it historically has been on the assumption that you're going to be either meeting someone or receiving original documents. So one of the things that we looked at in the paper, and I just want to explain a little bit about the regulations to put things in context, and then I invite sort of Doug back up here again, is just to take you through what the regulatory environment is where the customer is not physically present. And I'm going to predominantly look at that from an SFC perspective. There is a lot of now similarity with the HKMA, but in terms of what I'm talking about, it's going to be, I've looked predominantly at the new AML guidelines for the SFC. So what they've said is that and I should point out that the AMLO, that's the Anti-Money Laundering Ordinance, it has permitted for some while this concept of non-face-to-face. But what it requires is additional measures are required to be put in place if you're dealing in a non-face-to-face environment to mitigate the risks that arise from that. And so what the SFC's guidelines basically they clarify is what are the additional measures that require to mitigate in a non-face-to-face environment. So what are they? There is a provision which says that non-face-to-face, you need to adopt further verification of customer ID on the basis of documents, data, or information provided by certain bodies. And they say a government body, a regulatory authority, an overseas regulatory authority, or any other reliable or independent source recognized by a relevant authority. That's nothing new. That remains the case. What they've also added, they've said that you can also do that by taking supplementary measures to verify information. The ability to use supplementary measures, again, is not new, but what is new in terms of the SFC guidelines is that they've now provided some quite specific guidance in terms of what these supplementary measures may include, particularly the use of independent and appropriate persons to certify documents. So what they've done is now that they've set out and they've called it a non-exhaustive list. So that word non-exhaustive is good to have in the guidelines because you can stray from them if need be, but we'll talk about the risks of doing that if that occurs. But what some of the guidelines provide now in terms of who is a certifier, non-face-to-face. If you're going to rely upon a document, it needs to have been certified by an individual. Who are these individuals? So the guidelines have said, under the AMO, the new revised AMLO, it says an accounting professional. That term is now slightly broader. It previously used to be just a Hong Kong CPA. Now it includes a practicing CPA and a corporate practice under a professional accountant's ordinance. A Hong Kong licensed estate agent, that's new. So a new certifier, that's welcomed. A legal professional, you've always been able to have a solicitor certify. They've now expanded that to include foreign lawyers practicing in Hong Kong. Another certifier is a trust company or an authorized financial institution, and also overseas lawyers, notary publics, professional accountants, and service providers. So again, there's been no change there. So what the new changes in the AMLO predominantly have been around increasing the scope of the accounting professionals, Hong Kong licensed estate agent, and expanding the definition of legal professional. Under the actual guidelines, they also go on to say that you can also include a member of the judiciary, an officer from an embassy, a justice of the peace. A new provision they've said is that they've also included, in the SFC's guidelines, they've said, or other professional persons. And they said such as a CPA, but a lawyer or notary, which is already provided. But they've said, or other, and that's not, they've said it's up to you to determine. And they said financial institution can accept appropriate persons as a certifier if they consider them to be other suitably professional persons. But there's no guidance, unfortunately, yet as to what that is. And instead, what the note says is that, well, you can rely on this other professional person, but please remember that you remain liable for failure to carry out prescribed CDD, and therefore should exercise caution when considering accepting a certified copy documents, especially where such documents originate from a country perceived to be a higher risk. So the challenge there is greater flexibility, but you need to make a decision. And a lot of organizations, quite understandably, they don't want to have to make too much of a decision based on principle. They would feel far more comfortable being able to rely on a specific regulation which says if you do this and it's this person, you've complied. The reason being, as Douglas mentioned, there's been significant fines over the last few years in jurisdictions over breaches of this, including Hong Kong. Other certifiers also, in terms of supplementary evidence, includes checking against relevant data, and this is a new thing. So they're saying you can check relevant data against reliable databases or registries. So this is more flexible than before, because before there was a reference, I believe, to sort of government registries, but more flexible. It can be just reliable databases and registries, but you've got to decide, is that reliable? There's no list out there which is going to tell you that. And again, so that's going to be a challenge for the industry. What is also, they've said, is you can use appropriate technology in doing this. And Doug's going to come on to talk about that. But again, so there's a recognition that you can use appropriate technology, but you've got to decide, is it appropriate? And I think that's going to be one of the challenges going forward. And so the sooner we can get into an environment where certain technology is accepted and recognized, the more comfortable institutions will be in using that technology. One of the other things is which complicates it. If you're licensed with the SFC, there's a code of conduct that you need to comply with. And one of the things the code of conduct says is that you can rely upon certification services that are recognized by what we call the Electronic Transactions Ordinance. So if a certifier eligible under that ordinance is certified in original, you can rely upon that. Right now there's only two, the Hong Kong Post and something called DigiSign certification, so that's quite limited. What is quite useful to know is that there has been, since 2008, this mutual recognition of electronic signature certifications between Hong Kong and Guangdong. It was a pilot scheme, and that's still going. And last month, and what it's aimed at doing is identifying agencies in the PRC in the Guangdong area that can certify similar to the Hong Kong Post and DigiSign. So there's 3 PRC providers at the moment. What they've done is they've updated their guidelines in September of this year, basically to facilitate technology in using face-to-face identity verification. So they're anticipating that this technology is going to be coming from Hong Kong, and it's going to be, they will be prepared to accept that, subject to complying with various standards when using that in the PRC. I mentioned that the HKMA had also issued their guidelines, and again, effective from today. The good news is that there is now far more. If you just put the 2 guidelines side by side, there's far more harmony between the 2, particularly as regards sort of non-face-to-face. But one of the issues with the HKMA guidelines were that they didn't give examples of appropriate certifiers like the SFC did. So the SFC have given you some examples in Appendix A. You can look at that, and if you use one of those, you're fairly safe. The HKMA didn't give in their guidelines a list of certifiers. However, as I was in the office last night, an email arrived, and some guidance was issued last night, coincidentally, it was by way of an FAQ from the Hong Kong Association of Banks. So the Hong Kong Association of Banks have basically issued some FAQs, which they have stated are not, it's not part of the HKMA's guidelines, but they said it's with input from the HKMA, and in that FAQ they have listed out examples of what would be an eligible and approved as certifier, and those examples are pretty much identical to the ones that the SFC have put in their guidelines. So it's a bit unfortunate that that just wasn't in the guideline, because still we've got these new guidelines across the various industries, but in terms of reading them and digesting and picking out what's applicable, you still need to have a very large desk or several screens to look at different pieces of regulation. So I think that is going to remain a challenge. And so really, I think that one of the comments remains always that we want continuing consistency of regulation and guidelines. We want continuing dialogue amongst regulators, and that's basically regulators not just in Hong Kong to facilitate this, but overseas regulators, because we need to be able to import the technology that is acceptable overseas for this whole issue of non-face-to-face. And whatever technologies that we're going to be using in Hong Kong, we need to know that, again, that is going to be accepted overseas. So the only way to move forward is in terms of technology. So we need to identify which technology, who's going to pioneer this, which is acceptable. What the industry wants to know, there's limited risk in doing this. Big financial organizations don't like to be early adopters of things where there's a risk of breach of regulations, simply because it goes to their fitness and properness. Their licenses to operate can be withdrawn, or they can be subject to significant fines. I'll stop there, and you'll be delighted to hear I'm going to hand back to Doug for the rest of the evening, but we'll take questions afterwards. Thank you.
Thanks, Jeremy. I think that really outlined many of the key issues. And I think when we are looking at the context of Hong Kong, it's important to realize there are a range of reasons why it's difficult. It's difficult because we have a range of different regulators. And I think what Jeremy has identified is that we are making, particularly in recent months, some progress in bringing those together. But financial institutions are not operating just in the context of the Hong Kong regulatory environment. They are dealing with their home regulator, whatever jurisdiction that may be, and typically they're also dealing with a number of other major regulators, in particular the US and European regulators, and this highlights some of the cross-border challenges that we're seeing. And finally, certainly in the context of Hong Kong, we have often seen the emergence of quite a conservative approach amongst many financial institutions. And that is something that I think is beginning to be challenged a little bit by some of the newcomers. And what I would like to talk about is some of the wider trends that we're seeing around the world in this area, and what are some of the implications or lessons that we may be able to take away. And really, the first of these is part of the theme of this talk. It's FinTech. What is FinTech? And everyone has a different definition, but for me, and I think our view in the Council, is to look at FinTech very broadly. We've had another paper that we've issued looking at some of the FinTech challenges and making a range of recommendations. And we're seeing an increasing range of activities, not least announced by the HKMA, the SFC, the Financial Secretary, and others at Hong Kong FinTech Week this week. But when we look at FinTech, financial technology, there's been a very long interrelationship between finance and technology. Think about something like money or payment, coins, paper money, checks, electronic transfers, online payments, cryptocurrencies. This is about 8,000 years of technological evolution across the financial sector. So, technology and finance are not new. What we're seeing, though, that is new is much more rapid change than we've ever seen before. And that, I think, highlights FinTech across the four big areas that we're seeing it. One, traditional financial sector. It's something that if you think about the traditional financial services sector, technology has been transforming it for decades. Think about securities trading. Hong Kong Stock Exchange closed floor trading last year. It was the end of an era. But trying to find someone who is physically buying and selling securities, almost impossible. $5.5 trillion a day changing hands in Forex markets, almost none of that is physical money. It is almost all electronic data entry. So, long-term transformation in traditional financial services that is being accelerated by a range of new competitors, the FinTech startups. Startups have really exploded over the past 10 years, but it's not new. Think about PayPal. PayPal 20 years ago was a FinTech startup. Today, PayPal is one of the payments majors. Think about Alipay and WeChat Pay. 10 years ago, who would we have been focusing on international payments? We would have been looking at China UnionPay and its relationship to Visa and MasterCard. China UnionPay today has existential fears about being completely replaced by Alipay and WeChat Pay. Those are FinTech startups that have emerged. Today, Alipay, WeChat Pay, 800, 900 million customers, $2.5 trillion a quarter each in online payments. That is FinTech startups. That is digital transformation. The third trend that we've seen is exactly this, developing countries. Over the past 10 years, 1.2 billion people have gotten access to financial services for the first time. The largest portion of that 1.2 billion people, China, and more recently, India. What does this highlight? It highlights that across developing countries, we are seeing a leapfrogging of traditional financial services as technology, particularly mobile phones and smartphones, allows skipping of entire systems of traditional finance. My favorite example right now, Myanmar. Myanmar is a country of about 80 million people, has 2,900 ATMs. It has an 85% penetration rate with smartphones. Myanmar is going to skip entirely branch-based banking in the same way that much of the developing world has basically skipped hard landline-based telephone systems. The technology is better, and it is simply easier to move on to something else. So, our fourth trend is the entrance of technology companies. And I've already mentioned Alibaba, Tencent. These have been the best examples of what can happen. And this, of course, is something that we are just beginning to see in Hong Kong. But of course, there's already been the world's most rapid and complete digital financial transformation, which has taken place in the mainland. In Hong Kong, we're getting ready to issue our first virtual banking licenses. We've recently updated our faster payment system. And one of the biggest concerns, we know this in the context of the applicants who have been reported in the press for the virtual banking licenses. They include traditional financial services firms, they include FinTech startups, and they include giant local and foreign technology companies. Well reported that Hong Kong Telecom is one of the applicants. And that is a firm which already has a reach to the majority of the population of Hong Kong. What does this mean? It means that in a very short period of time, one can see something move from a new idea to very large. And this, for more than many other places, is a real challenge in the context of Hong Kong. And many of the discussions, many of the things that we highlight in this paper, as well as some of the things that the Monetary Authority and the SFC have been talking about, particularly about the past couple of days, is about using technology from the standpoint of regulatory compliance as well as regulatory monitoring. If we think about where some of the greatest spend in the financial services sector over the past decade has been, it's been compliance. Compliance has been, in the aftermath of 2008, the most rapidly growing sector, part of the financial services sector. That started out with financial institutions basically throwing bodies at the problem. But over the past couple of years, we've seen a change of strategy by many firms around the world. And that is an increasing application of technology to many compliance functions in order to be able to centralize, automate, achieve better results, and also reduce costs. So in other words, the thinking is that perhaps one can replace some of these compliance bodies. In the compliance field, it could be the people that are in the back room Googling the name of people who are seeking to open new accounts with more automated systems that are not only cheaper, but they're also more effective. Large numbers of financial institutions looking at data analytics, at machine learning, at AI in the context of their own customer services. But one of the problems for many of these is that even for the largest financial institution, they are missing many of the network effects. In other words, a carefully crafted money laundering network will take place across accounts run across different financial institutions, which will reduce the likelihood of any single financial institution being able to identify suspicious transactions. Add in cross-jurisdictional activities to make it even more difficult. And what we are seeing is an increasing range of regulators using technology themselves. And once again, lots of discussions about the Monetary Authority, particularly in the context of the virtual banks. How are they going to use technology in the context of compliance and regulation? Lots of announcements over this week by the SFC about building new systems. Think of Edgar in the United States, a system where you digitally file documents which can be searched and used for analytics purposes as well. One area where we're seeing an increasing amount of attention to these sorts of functions in many jurisdictions is customer identification. So if we think of Singapore as one example, building a database of all of the different reports across all of the financial institutions operating so that the regulator, the MAS, the Monetary Authority of Singapore, is able to run analytics across all of the information coming from the financial services sector in order to identify patterns, which enables it to engage in proactive enforcement operations to protect the markets. And what we are seeing increasingly in a range of jurisdictions are strategies that are about building digital infrastructure to support better functioning financial systems. And what we've identified are really 4 different aspects. The first, this is aspects from my research team as opposed to FSDC, though in the FSDC report we look at some of these aspects. The first is really about digital identification, the ability to use digital forms of identification, particularly for account opening. And this is something that we are seeing in an increasing range of jurisdictions around the world. The UN highlights that today, 77 countries around the world have digital ID projects in place. Basically, these are about issuing digital identity cards with biometric factors, which can be used not only for quick and simple face-to-face identification, but also for non-face-to-face identification. Essentially, the idea is that embedding biometric factors into digital identity systems provides a more robust way of identifying whether or not the person in front of you is actually who they are. What is one of the least effective ways to identify someone? Well, it's the one that we see the most frequently in Hong Kong. What is that? A photocopy of an ID document. A photocopy of an identity document is one of the least effective means to actually identify that the person is who they say they are. But it is one that has a long tradition, a long history, and legal support for, and as a result, that is the default operation. But in an increasing range of countries, we are seeing other approaches. This then enables the use of digital payments. We often see the use of electronic accounts for a range of services, which then enables very rapid expansion of financial services products in online environments. And we've seen this certainly in China. We've seen it in Russia. We're seeing it in India. We're seeing it in an increasing range of countries around the world. And what we identify in the context of the report are 3 particular areas where we recommend as the Council that the government takes a more proactive stance. The first is about building a digital identity infrastructure. And everyone will have a Hong Kong ID card. Hong Kong is not like the US or Australia or the UK or Canada, where there are lots of political issues around having some sort of national ID card. We already have one. We have had for 15 years a Hong Kong biometric identity card, which uses thumbprints every time you go across the border as a fundamental means of identity. Some of you may remember, and Jeremy mentioned this, that when it first came out, there was also a system for e-cert, to be able to have a sort of digital identity system. And some of us actually went down to the post office, registered for the system, received a CD, which you would then take home and put in your computer. Your computer would then crash, and no one ever really managed to get it to work. We were perhaps a little bit ahead of our time. Today, we're in the process, as you all know, of rolling out new Hong Kong ID cards. Those ID cards will provide even more robust forms of biometric identification. We recommend that those could potentially be used in the context of not just photocopying them, but actually biometric checks. One example that we're seeing around the world are a range of systems that do not necessarily copy information, but query a database on a yes-no basis. Is there a match between these irises, this face, this fingerprint, and a centralized database that provides a certification of identification? Many of you will have passports from countries which have an electronic system, and you will go in at the UK or the US or Canada, and that system embedded in the passport will make things go much quicker. One benefit of Brexit, for those of you who have one of those passports, it seems as if we're going to get a fast line that the Europeans will not get. So, one potential benefit of Brexit. We are, at the moment though, in Hong Kong, focusing on the replacement of that e-cert system, the EID system. How can we develop a system of digital identity which is perhaps separate from the smart ID card? For a variety of reasons, we may decide we don't want to actually enable use of the card, but to the extent that people go to the post office and use that card to certify with the post office on the basis of a biometric check their identity and register for an EID system, there is no reason why that EID should not be usable in the context of opening accounts. In particular, the sorts of systems that we are now seeing in an increasing range of jurisdictions. One of the best examples is what is called the MyInfo system in Singapore, are network structures that do not bring together data in a centralized place. Increasingly, there's a consensus that bringing lots of data into one place, like Cathay Pacific or Equifax in the United States last year, brings with it lots of risks. Increasingly, what we're seeing are distributed data systems. Lots of different government departments collect data for different reasons. You don't necessarily want a system that brings all of that data in one place. But to the extent that you can build a system that allows you to check the accuracy, or for an individual to provide limited access to a user like a financial institution for that data, offers massive potential benefits in the context of reducing costs, increasing efficiencies, dramatically improving the customer experience, and of course as well also better chasing criminal use of the financial system. And so these are the sorts of systems. Australia has just announced that it's creating a similar system, similar sorts of structures in the context of the EU and a range of other jurisdictions. And that is really our first point. But actually, we argue that you should be looking not just at Hong Kong ID holders, which is an important, we have to get this to work. If it doesn't work for the local population, the rest isn't really as successful. But from the standpoint of business in Hong Kong, Hong Kong's competitive position, we need it to work for others. We need it to work for not only individuals, but also legal entities. We need it to work not only for local individuals, but in particular from an asset management standpoint, non-local individuals and legal entities. And we highlight a range of ways how this could take place. And the thing is, once Hong Kong has put in place a system which produces digital information that is acceptable, golden source from the government, for use by financial institutions, then that system can be used as the basis of recognizing other similar systems in other jurisdictions, whether the mainland, Singapore, Australia, the EU, or elsewhere. Once you have a system, it makes it possible to recognize similar systems of digital identification from other jurisdictions, which can then be relied on in the same way that we will rely on a passport issued by another jurisdiction. But instead of taking a photocopy of that passport, this would be an electronic certification based on biometric factors that this person is, under the identity system of their government, the person that they claim to be. And that provides a very strong way forward in the context of basic systems of digital identity. If we wanted to go further, we could also allow people who come to Hong Kong to register while they are here. In other words, a number of countries, Estonia, for example, has systems whereby individuals from other jurisdictions who physically come there can go through a similar sort of registration process, which then qualifies them in the context of the EID system, which allows rapid opening and access of accounts. By no means is this a sort of far-fetched idea. If anything, this is the direction that much of the developing world and an increasing range of the developed world is going. Companies, can we do the same thing with companies? There is an increasing amount of discussion, particularly at the international level, about whether or not we may be able to build an internationally acceptable form of corporate identification. How could this happen? Well, one outcome of the G20's post-crisis regulatory reforms in the area of OTC derivatives has been an agreement that any entity entering into an OTC derivatives transaction must have what is called an LEI, Legal Entity Identifier. These were embedded in the most recent implementing guidelines in Hong Kong for OTC derivatives. In the context of the EU, it has been expanded far beyond that. And in the context of something called MiFID II, the Markets in Financial Instruments Directive, which governs basically all transactions in financial markets with EU counterparties, there is now a requirement that any entity from another jurisdiction doing business in the securities markets with an EU counterparty must have an LEI. LEI systems provide the basis for a potential system of corporate identification when combined with another initiative, two initiatives in fact, that we are seeing. The first is a G20 agreement to require transparency of beneficial ownership of companies. As jurisdictions around the world move to require transparency of beneficial owners, combined with legal entity identifiers, one begins to have the basis of a cross-border electronic mechanism for identity management for corporates. It will, of course, start with big companies, but if successful, it will provide an incentive for other companies to get LEIs which have been issued by authorized issuers, backed up by transparency of beneficial ownership in order to more easily access accounts and services in a range of jurisdictions. So, our next is really about a KYC utility. And there are two aspects of this. If one has a system of digital information like the MyInfo system, one really doesn't need much in the way of a KYC utility. A KYC utility provides a network where you can check certain facts, corporate ownership, corporate records, individual identity of directors, tax information, which is now transferable under the OECD framework, which gives you the core information that you need in the context of know your customer rules. But if we don't go this route, there's going to be a need for some sort of jurisdictional KYC utility. An increasing range of jurisdictions are announcing these and building them. Why? Because as Jeremy highlighted, from the standpoint of the private sector, even if you build a utility, one, it's not going to have sufficient coverage, but two, you're never going to have sufficient assurance that you can rely on it. Certainly the US Treasury, in a report a couple of months ago looking at the future of technology in the US financial services sector, highlighted that going forward in the context of KYC utilities, essentially governments are going to have to take a leading role in order for the industry to be able to rely on those, and more importantly, for law enforcement officials in those countries to be able to generate sufficiently robust data sets to improve market integrity. And finally, looking forward a little bit, we think that a similar system could be built for suitability requirements. In other words, once you begin building these sorts of databases, you can also build systems that provide information about assets or background, all of which makes it much easier in the context of client onboarding. Jeremy mentioned some recent notices from the Hong Kong Association of Banks. We're expecting that the Hong Kong Association of Banks, which is engaging in a process of developing some proposals for a KYC utility, will be issuing those proposals soon. We're hoping to see some of the details of the EID system soon. And I think it's something important that as we think about the future of financial services in Hong Kong, to realize that the technology is increasingly being adopted in a lot of other places, which, if we pursue similar strategies, can address many of the fundamental pain points and maintain our competitiveness going forward. We've highlighted at the end of these slides a series of recommendations about the structure of these sorts of systems. And I think at this point, Jeremy and I would be happy to take some questions and get your views on this. So thank you very much. Luckily.
Once again, thank you. I see questions.
Thank you, gentlemen. Thank you for the presentation. My question is, because the pain point for opening bank accounts is mainly on the corporates. Professor Anna, you mentioned about the digital identifier for corporates as well. I think there's a suggestion by Ernst & Young recently on digital passport as well, where I think the idea is similar to yours, but can you comment on that, because the data controller and updater responsibility will rest with the SME itself, which is quite different as well from the LEI you mentioned as well. But for SME to update the information, to control information, theoretically it's good, but in practice, is it, say for Hong Kong, the SME, will they be able to do it, or will the information be accurate, that sort of thing? So what's your take on that?
Yeah, I think this is a big issue, and I think what we're seeing is that in most jurisdictions, one of the problems with, say, corporate data, particularly sort of companies' registry data, is that it's not certified. It's just reported by the individuals. But what we're beginning to see as a result of, one, if we think about many companies' registries, including companies' registry here in Hong Kong, they have undergone a process of digitization already. So everything is digitized. The LEI system is basically requiring them to build in certain levels of robustness in the context of being recognized for EU MiFID purposes. So we've got that directionality, but the key thing is actually being able to integrate it into a sort of data network. In other words, one of the biggest challenges are simply around things like identity of directors, addresses of directors, income, etc. If you have basically a digital identity system which allows you to prove identity of the individual when they register, plus link that to, say, reporting information about addresses, and from the standpoint of company records to make sure that financials are updated. It provides the basic elements of corporate identity. From that, I think then an increasing range of private companies are already engaged in this market on building other things. We have some that are already trying to provide similar services. I think what we'll initially see is larger companies that are already getting LEIs move in this direction. But as jurisdictions implement, in particular, not only the LEI systems, but also the transparency and data network systems, that's when corporate data network to other golden sources of data moves from being basically just declaratory to certifiable. And that's when we can really see on the corporate side some big, powerful changes.
Hi, I have two questions, and I'm not sure if they make sense. I'm a layman. I'm not necessarily a finance professional or a compliance professional. But if larger corporates will be given, I don't know, some kind of greater preference because they have data repositories and all that, wouldn't that create some kind of data-based inequality? Or if there are like certain countries, like the G20 countries, where you're able to access information and you trust that information, but not other data from other countries, doesn't that create some kind of inequality in some basis? And also, secondly, how would that idea operate where you said that there doesn't need to be a central repository of data, but data can be decentralized? Then how does that work per se? Because you do need some way of checking, right? So if there is no database where all the data is, then how do you control that?
Yeah, two very good questions. The first, I think, on the data inequality is it's already the case that if you're a big company, it's much easier to open an account than if you're a small company. And one of our biggest problems internationally, particularly in this region, which has occurred as a process of de-risking and a reduction in correspondent banking relationships, has been that in particular, if you're a company, a small company, from a developing country, particularly in Asia, it's much more difficult to open a bank account than for just about anyone else. And so that's actually a fundamental problem that the G20, FATF, and others have already identified. And so there's been an ongoing effort to try to come up with ways of addressing this. And I think increasingly we're seeing many of those moving in the direction of trying to apply technology to reduce some of those differences. And so I think it already is a big issue. But once you put in place essentially the systems, then other companies can more easily access them. We've seen this in a number of jurisdictions that have built these sorts of networks where basically what it does is it drives the customer acquisition cost dramatically down. And once the customer acquisition cost becomes really cheap, as it is in an increasing number of countries, that dramatically expands the sorts of businesses that are commercially viable and the sorts of customers in terms of small amounts of money and assets which are attractive. And I think this is something where we're seeing, if you think of Alibaba in China or many others, basically what they've managed to do is drive down the cost through automation to enable them to serve customers who, in a traditional banking system, for instance, would not be commercially viable. So, yes, it's an issue, but it's already an issue, and it's something that I think we can move best, and lots of discussions around doing it. Data decentralization. This is essentially the idea. If, for instance, you think about one of those e-passports, when that is checking your identity information has not been transferred to that other jurisdiction. You are essentially querying a database which is somewhere else, under the control of some other government, as to whether or not this person who has this piece of identification is the same person as in the identification. So one example where we're seeing this very frequently is in the context of, say, refugees, where there may be an iris scan system where the data are kept in a secure database in Geneva, but you have an Android app that simply sends a scan to that central database. That database compares those two scans and says yes or no. Because after all, no one needs your iris database, your iris data. And most of us really, there's an old joke in data that in the United States and many other countries, but it's most famous in the US, you have these rules on drinking age that 21 across the United States, you can't buy a drink in a bar. And so whenever you are asked by a bartender in the United States for proof of identity, people will give them a passport, a driver's license, and basically you are giving the bartender far more information than the bartender needs. The bartender doesn't need to know your name. They don't need to know your address. They don't need to know your age. They don't need to know your driver's license number. All they need is a yes or no. Yes, this person is 21 years of age, or no, they're not. And that's increasingly how systems are or should be designed. It's thinking about limited stores of data in secure locations, often with multi-level protections, so that you don't end up with situations where lots and lots of data is aggregated in one place. You break in and you can access everything. Often governments are already collecting this information, and so it's often best to leave it where it is, but enable some sort of checking methodology. And this, I think, is something that we're seeing in an increasing range of contexts. And from the standpoint of the financial services sector, it's a very strong way of dealing with these pain points, but it does require governments to think through data catalog design and how third parties can use it.
I think because of time constraint, we can cater the last.
Thank you for presentation. Can you share with us what other jurisdictions with successful eKYC utility? Like, are those actually government-driven, or more like they're still developing industry initiative or from the vendor system? Thank you.
You have lots of places where vendor systems are developing, but I think as the recent U.S. Treasury report recognized, there's really a need for some level of government involvement in the context of industry feeling comfortable relying on those systems. And it's always going to be the case, I think, as Jeremy highlighted, that if you have a governmental system which per se industry can rely on, that's going to be much more rapidly adopted than a system where the potential liability for the choice of system still rests with the private sector participant and the one that they're engaging for that service. We've seen systems developed in South Africa, in Luxembourg, in India, systems being rolled out in Singapore, in Australia, in an increasing range of jurisdictions and designed in different ways. Often there will be some sort of private sector involvement. There may, in many cases, be some sort of monopoly provider that is designated by the government in order to separate or commercialize the function. But generally what you are, I think, increasingly seeing is a need for some sort of government involvement or at least recognition of the system that comes out in order for it really to be widely adopted.
As a concluding remark, the only thing I would add to that is I also think that a lot of this will be driven by data protection issues, and ultimately, who do you want holding, storing this this information, a government or private sector? So that's I think will really determine some of these issues as well.
Well, Once again, thank you very much because of the time constraint. I think on behalf of the school, once again, thank you, Professor Ng, Professor Ng. And your opinion is key, so if you don't mind, please fill in the questionnaire form and put it in the box. And once again, thank you for coming.
Good job. No, actually, yours worked out. It did. I felt bad because I had sort of given you what is potentially drier. You didn't do that. You made it actually very interesting.
If you don't mind, I have a moment request.
Yeah, please. Hi.
Oh, got it. Thank you.多謝你啊！多謝啊！精唔精彩啊？精唔精彩啊？唔係啊？哦，好啊！我哋一年都會搞幾場呢啲。係咩？係咪啊？好啊！好啊！好啊！我哋第日有再邀請你啊！多謝多謝。Stella。嚇？好，拜拜。多謝。我哋要問一問個 speaker 嗰個 copyright 係啦，係啦，因為我哋都要請示佢可唔可以公開嚇。或者你再打話俾我哋，可以打翻佢哋嗰個嚇嚇，係好嘛？好，唔該。
Well, you got a good turnout. Maybe it helps the FinTech week as well, maybe.
Yeah,
but,
right.